Hello, welcome to IVoT Eye on Investing, a discussion of the markets and investing from a long-term fundamental perspective, hosted weekly by IVoT Academy. I focus on fundamental because fundamentals are what really drive the overall market, and Emile Westergaard is going to dive into what fundamental perspective is. We're joined today by our two IVoT experts, market analyst Andrew Tang and equity analyst Emile Westergaard. This week, Andrew will take a look at the latest economic and market data, including Moody's recent downgrade of U.S. debt and China lowering its one-year prime loan rate. Emile is going to analyze AT&T using the powerful IVoT Forecaster tool. Welcome, Andrew. Welcome, Emile.
Thanks for having me.
Yeah, thanks, man.
Each week you bring so much interesting information, Andrew. Why don't you kick us off today with some of your thoughts on the Moody downgrade?
Yeah, the Moody downgrade on U.S. debt, it's really nothing new because we originally heard it from the S&P, which downgraded the U.S. debt back in 2011. And the most recent downgrade was from Fitch. That was back in 2023. And back in those years, obviously, the US debt levels were much, much lower. In 2023, we were only at about $14 trillion. I mean, in 2011, we were at about $14 trillion. Now we're ballooned to somewhere around 36.8 trillion. It's quite a heavy load on any country's back. And obviously, we can grow out of the debt problem by expanding the denominator, which is the GDP growth. However, at the current rate, combining with the weak demand for 20 plus years in the US Treasury auctions, as seen by the latest auction market, what the public is really saying is that, hey, we're protesting because we are not sure of the fiscal health of the United States budget. And even the budget office are projecting that the debt will spiral out of control. And their model is using 3.5% assumption interest rates. And what is the reality? We're at 4.25%. So this difference means billions of dollars in interest payment. And right now, we are already spending over $1 trillion per year just on interest payment alone. And so that's what's happening. It echoes the outcry for the fiscal, irresponsibility. Can the president do something about it? I think he done the best that he can because the budget ultimately is passed by Congress. And if you're going to tell Congress not to spend more and to save more and, to cut the entitlement program, I think that is going to be a really tough one, for Congress to pass. And so, yeah, we continue to kick the can down the road. I just hope that everything comes into play and the positive will come out. Otherwise, we will see a lot of trouble, ahead of us by the huge bond sell-off in the marketplace.
Andrew, if the United States was a company, what would it be rated?
That's a trick question here. But right now we're still one notch above the top rating. But I have to see, there's so many moving parts here. I can't really put a grade on it. I'm not in a position to do that. But I have to agree with the rating agency that these downgrades are justified. But many have said that, Moody is a little bit late on it, late on the downgrade because there are actually more things that are done that are quite positive. For example, there's the Department of Government Efficiency that have found, good money, waste, fraud, and abuse. All that is revolutionary because it hasn't been done before. So in a sense, Moody's downgrade at a time when there's actually a difference coming in from the positive side, which is completely opposite. But I think this downgrade for Moody was necessary because there could be further downgrades, and that's the threat. Will it happen? Nobody knows because only time can tell. There are many opposing forces that can make the situation better or worse. How can we make it better? Well, we can increase our tax receipts. if we increase our tax receipt or we see meaningful growth in our nation's production with the AF8I and also with the expansion due to innovation and technology overall, that is deflationary and that will promote growth and promote productivity. That can offset the huge amount of debt that we have to carry. Sure, that can happen. If we fail to do that and if we still continue to spend much more than what we break in, then yes, then a continuation of protests in the bond market will reflect a weaker dollar, much, much weaker. And so, the results are remaining to be seen, but I'm hopeful.
Well, I wouldn't just say, since Ed started out talking about how we're a fundamental platform, and I think it's a great way to frame it, Ed, which is to say, what would the US look like as a company, right? And so, you can fundamentally assess debt to revenues, right? So we could say we're sitting on, what's the debt number right now, Andrew?
It's about 36.7, 36.8.
So we're about 6 times revenues in terms of the debt, right? Because we're about a $6 trillion annual. Is that right? Or what's the annual GDP?
Right now, I'll tell you in a second. Yeah. Yeah, we're at actually 27.
27 what?
Let me see if it's 2 point. Hold on. Let me see.
Maybe.
This is billion. Yeah, we're at 27 trillion.
Oh my God, I'm so far off. That was
Yeah,
embarrassing.
a little bit far.
So we're at 36 trillion of debt on 27 trillion of it revenue. You could call the taxes the cash flow, right? And so then you'd have, what are the tax revenues of the country per year at the federal level? And you could see a multiple of cash flow in terms of debt. And that would be how you'd look at a company, I think, basically. So that would be sound and also be interesting. And I think we could do this next week. I'll set this up for us where we could compare our debt to cash flow versus, China, Europe, whatever. We can look at some various comparables to see where we stand in the world on a debt to cash flow basis.
Yeah, I mean, we have a lot of ratios that are already ready to use off the shelves. Like, for example, debt to GDP ratio right now stands at about 122%, 123. Right. Yeah. So you can look at that relative to the production, but tax receipts, also interest income and other forms of income will total the, amount of, total intake, for the nation.
Got it.
We can definitely put something together for next week.
But it doesn't change the fact of how much money we have to pay out in interest. All the ratios, you can toss them out the window when you look at just the gross amount of money that we bring in and how much we have to pay out, and then what's left over for our country to function. And that's where the big problem is.
Yeah, exactly. And the challenge here is that we continue
I want to just counter that for a moment. The gross number doesn't mean anything. It only means something relative to the intake.
Correct.
$1 trillion numbers sound big, that they may say, but the reality is that it's only important what that number is relative to the number that we have to pay it.
Yeah.
I don't think I would disagree, Ed. I think that the gross number, again, that's the part of the problem, right? The media loves to play up these big numbers because they sound massive. But from a fundamental perspective, we really have to look at what they mean, which has to do, again, with multiple of GDP, though GDP is kind of lame, right? Because there's a company doesn't function on its revenues, it functions on its profits and cash flow. And so we really have to look at that payment that we're talking about, whatever you said $1 trillion per
year. Per year. So that's the amount of interest payment.
Compares to how much intake is the U.S. government taking from a cash flow perspective, and maybe we can pull that together for next week.
Well, I look at it this way, because the annual nation's budget, it's somewhere around $5 to $6 trillion, which is a lot. And if you say $5 trillion, then if you pay out, roughly a trillion in interest payment, that's 20%. Right. So that's where the
20% of
problem
your,
is. You know, for
right.
all of the money that will pay for all the entitlement program, including the salary and the benefit of all public service folks, that's 20% of that budget, of nation's budget goes to interest. That's not sustainable. But if the auction continues to be weak, and if the long-term rates, you know, of US continue to go up, it will challenge the ability of the Fed to come in and lower rates. You know, even though we lower rates on the front end, you know, it will be challenged. Yeah. So that's where we're at, Ed.
All right. Tell me about China lowering its prime.
Yeah. Well, China is basically doing all that it can to counter the pain that is inflicted on the country due to tariffs and due to the ongoing negotiations. And again, I have to reiterate that China it's putting out a rosier picture than what it actually is going through. Now, I tap into an expert in China with Don Shong of Digging Into China, and he just came out with amazing data that just showcased that the bank lending rate for January, February, March is one rate. February is lower due to Chinese New Year, but long come April, boom, you see a huge drop in commercial lending. And you also see a spike in demand for repayment. So what you're starting to see is the business side of things in China are deteriorating. And the banks are feeling the pressure that a lot of the loans that they lend out is becoming at risk. So therefore, they're demanding the entire loan to be paid back. And are they lending out new money? No, they're not. Actually, it's been the lowest, one of the lowest rate of lending for a commercial bank. So the government can hide anything they want, but when this type of data falls through and others pick up on it, you'll start to see the picture of their financial system showing cracks. And that is a huge problem. So, yeah, China is going through quite a bit of pain, even though they advertise publicly, they're saying that their domestic economy can withhold, you know, can withstand all kinds of pain that the US inflict on them. But if factories and if China's economy is in fact an export economy where a lot of the companies have 60%, you know, of their businesses going into the US, that is trouble.
I'm pulling up here the prime rate as it's been moving over the last what is this, 5 years?
Yeah, and you see that it's continued to lower. But even at these lower rates, they're not lending. They're not lending as much as people think that they would. So, you know, growth is basically ground to a halt. And if China cannot get the, you know, other countries to band together to help their country out, it is going to be more pain for China. And obviously, you know, the cards are going to be held by the US
Does
as
that
the
look kind
consumer.
of like 90s Japan a bit?
Yeah, very similar. You know, very
Stag,
similar.
what do you call it? Like stagflation? I don't know. What do you call it? Just, nothing.
Well, stagflation is that if you have very weak growth or no growth and inflation at the same time.
Oh, I got it. So this
China is completely different because they're undergoing deflation. They have a
deflation.
debt spiral out of control, but deflation is putting a cap on their growth. When you have a massive problem with deflation, especially with their real estate area, people are not buying. No matter how you know attractive you make that investment look, they're just not going to buy because they're waiting for the economy to strengthen up. They're also waiting for the property to show some increase in value. Otherwise, they feel like they're putting money into a money pit, catching a falling knife, however you want to put it.
Well, something that's not a falling knife is AT&T. Emile, why don't we go to what your IVoT forecaster has to say about AT&T This is a stock that I wanted you to do the analysis on. We have a very big position in AT&T. We started buying it around 18 and 17. So our income is really good from it. But I'd like to know what point do I look to sell out of it?
Sure. Okay. Well, first of all, let's just pull up we're long-term investors here at IVoT. So the 5-year return on AT&T is 18%, which is great. I mean, anything above 10% from an investment perspective is what we're looking to achieve. And so the business has been able to increase its cash flow. There have been a bunch of things that have gone on during that time flow. I know at the time they spun out the Time Warner business, I think it was. And so, that would, but in any case, this is what you netted as a shareholder over the last 5 years. Now going to the tool, and this is interesting, right? Given that we were just talking about the US and companies with a lot of debt, right? So let's take a look. And AT&T compared to what we've been looking at lately on the show is really pretty mind-blowing. The stock right now is 27.42, which gives us roughly $200 billion market cap on AT&T. Now, according to our forecaster, the company did 10 billion in cash flow in the most recent quarter, first quarter 2025, up 3.5%. So very modest cash flow growth, but growth, which would equate to a calculated cash flow enterprise value of $900 billion, and which would be $125 per share. So in other words, you're paying $27 for a cash flow stream that's theoretically, based on the IVoT methodology, worth $125. You have an implied 356% return, which, I mean, granted, the cash flow growth is slow, but it's growing. It's not falling apart, and you're buying it at an extreme discount. The question becomes, why are you buying it at such an extreme discount? It's been at this discount. I mean, again, it's up 18% per year, but it's still trading at at whatever you call it, 25% of its value from a cash flow basis. The one kind of hole in this story, if you could call it, would be their net cash position. And this goes back to our discussion of the US in a way. They're sitting on $109 billion of net debt. So that is a significant debt load that they carry, which, is against their cash flow stream every year. Because again, cash flow does not, from our perspective, include the debt payment. So they have this cash flow of, where do we go back now to the top, of 10 billion a quarter, $40 billion a year to cover $100 billion of debt. And $100 billion of debt, assuming even aggressively that that's 10 billion, they pay it at $40 billion a year in cash flow. So I think that's basically the story. I mean, again, we know the business. It's got, the mobile, it's got wireless for consumers. It's got wireless and mobile for business. Those are the big pieces. It's got some other pieces as well. It's got a stake in Direct TV. But I think that's really what you're owning, Ed. And so I guess from a fundamental perspective, you're not selling this thing. I mean, you get a 4% dividend yield, and you get to own something that's exceptionally cheap as a long-term investment. I guess that's what the tool is telling us.
Yeah, and we bought it where we were getting a 7% dividend off of it.
Wow, great.
Yeah, because of your cost basis for the audience. Yeah. No, I like AT&T, and I like a lot of communications utility companies here. And the reason why is communications and the demand for connectivity, it's just going to increase. If you think about data center, it's blowing up, meaning in a good way. The build out of the need to compute is blowing up. Then that means the connectivity demand is also going to increase. And I think AT&T with their 5G initiative is reaching out to approximately 280 million folks. That's not a small number. That's a pretty good number. Their fiber is pretty highly rated as well. And AT&T is one of the bluest of the blue chip companies, stable growth. And of course, with the dividend play, as a value play, I think there's tremendous value here as well. And going forward, and again, with at least 4 rate cuts that are in sight, it's just going to help out with companies that demand on debt to survive. And utility companies, especially in the communication areas, is going to benefit.
Well, for those of
just one more. Oh, sorry. Go ahead, Ed. Yeah.
I just wanted to mention that for those of you watching, the IVoT Forecaster that Emile went through is something that you can grab a hold of if you become a member of the IVoT community. So I really encourage all of you to look into joining the IVoT Academy.
Yeah, and
That's
just
a good
to show
looking
you what you
module.
can do with the tool, because now we're future, we own the shares for the future for investors. So if we say that they continue to grow revenues at 2%, and then that would take the shares up to 129. Not a big difference. They picked up 40 basis points year over year in profitability, and I think that goes to just as kind of, so if we say that they continue to lower their cost basis down to 55% over the next 3 years, if they can just do that run rate, then that would get us up to a $134 value in 3 years. And I think when you actually look below the hood, and we have a level 2 tool where you can do this, they have some legacy business that's dragging on them a bit, legacy old phone style business. And I think you might see this go up to 4%, in which case, depending if the legacy, and then, you get up to a return from the current implied value, but obviously a 400% return based on where it's trading right now. So again, I'm really showing you more to show what you can do with the tool. I want everyone else, the whole point of IVoT is you come in, you study the company, and you make your own forecast and decide whether you think it's a good investment. We do not, and we're going to say it again here, make recommendations here. We're simply showing you what the fundamental view is from a cash flow basis.
Well, I want to thank both Andrew and Emile for taking the time today. I want to thank you for watching IVoT Eye on Investing. IVoT's sophisticated yet simple tools equip you to analyze, forecast, and manage your financial future, including budgeting, investments, credit management, wealth planning, and business management. Please subscribe to our YouTube channel and click on the link in the description to register for early access to the platform opening soon, which includes access to our powerful IVoT forecasters and fundamental investment training. See you next week in another eye-opening and invaluable session with Emile and Andrew. Thank you very much.
Thanks for having me. See you soon.